Thank you. So good evening, everyone. I welcome you all to our LVRC batch for revision of the subject of GST. So we are into an important topic. The today's topic for revision is imports, export under GST. Since this is it is important to understand that when we talk about import export, originally the subject of import and export is coming from customs law. However, customs law is limited only to transaction of goods. So when we talk about imports and exports under GST, there are two criterions for deciding import export under GST. One is import export of goods, which is flowing from the customs law, and the other is import export of service, which is exclusively limited to or related to the GST law, particularly the IGST Act. Now, what is the difference? The difference is when we talk about import export of goods, we have to refer to customs law for all the procedural implications, all the compliances, including the valuation. However, when we talk about import export of services, valuation, conversion of foreign exchange, time of supply, valuation, everything is decided as per the IGST Act. So this is an important and interesting point. Now let me take you through two, three important definitions before we can start with the provisions. So export of goods, this definition is a replica of what is there in the customs law. So export of goods with its grammatical variation, cognate expression means taking goods out of India to a place outside India. And similarly, if you see the import of goods, the definition is vice versa. With its grammatical variation, cognate expression means bringing goods into India from a place outside. So what is very important is for transaction in goods, the physical crossing of boundary is important. However, when you study the customs law, over there you realize that this physical boundary is not the physical borders of India, but the physical borders of customs. So even though import export is defined as bringing into or taking out of India, however, for the purpose of customs levy, this definition, this concept has been, you can say, modified to mean crossing the custom frontiers of India. That is why the definition of custom frontiers becomes important. Notice custom frontiers of India, it means the custom area as defined in section 2, and here they have referred to Customs Act only because we are not defining it. Customs area of Customs Act means the area of customs, station, warehouse, and includes any area in which import or export goods are ordinarily kept before clearance. So it means all areas which are under the custom controls, including the station, the warehouse, and the area where goods are stored. Just for your interest, if you observe everywhere in the customs law and also equally in the GST law, whenever the reference is made to imported goods, it is always a past tense. But whenever a reference is made to export goods, it is not exported goods, it is export goods. This is a striking difference, and it is not for any grammatical usage in the sentence framing. Anywhere, even where the caption is to be given, where no grammar is involved, it will say imported goods and not exported goods. It could have been exported goods as well, but that is not the case. I'll tell you the reason why. because customs law applies once the goods come into the territorial waters of India, which technically means the goods are imported, though still with the custom authorities not yet cleared. Whereas any custom law can exercise its power before the goods go out of India. If the goods cross the custom boundaries of India, sorry, not custom boundaries, the territorial waters of India, then no law will have any control over those goods. Hence, for all export procedures, we require the goods before they are exported out. Hence, we call it as export goods. But for import goods, you cannot exercise any control, any jurisdiction until the goods cross the territorial waters and come inside the Indian boundaries. So the relevance of imported goods is goods entering the territorial waters of India, but not yet cleared from customs. That is only the uh, frame until which these goods are imported goods and all customs law apply. And for export goods, it is before they go out of India. Now, some other important definitions. Now, this is going to be important, that is deemed exports. For those who by chance have studied earlier laws or have some idea about earlier laws, there was a different connotation of the term deemed export under the earlier laws. However, the GST law has changed the definition. In GST, deemed export would mean those domestic supplies that is happening within India which are notified under section 147. So we have a specific notification that we are going to see. We are going to read the notification to identify what are those scenarios. Now coming to the definition of export and import of service. These two definitions are exclusively from the IGST Act. They have no reference in the customs law, and no part of the customs law applies or refers to export of service or import of service. Now, export of service means supply of any service when supplier is in India, recipient is outside, and most important, place of supply of the service is outside. So until and unless these three basic things are present, it cannot be an export. But since we have many export benefits associated to it, the next part is that what will be export of service in order that you are able to get the benefits. So the fourth criterion is the payment for such services is received in foreign currency. And fifth is the person who is sitting outside to whom you are supplying should not be your own unit or your own branch. Because if you are supplying to your own branch, then technically the government of India is not benefited because it is you only who is sitting outside. So fifth condition is that the recipient and the supplier should not be branches of the same entity. Similarly, if you see the definition of import of service, it means the supply of service where supplier is outside, recipient is inside, and the place of supply is inside. Importantly, for being import of service, there is no requirement that the payment should be in foreign currency or the recipient and the supplier are different persons. So these two conditions present in the export definitions are not present over here. Then we have a very interesting concept of intermediary, though now post amendment in the GST law, which will happen or which will be brought through the upcoming budget in February, maybe this definition will not hold much relevance. It will get diluted. But until that happens, this definition has some significance in the GST law. What is the definition? Who is an intermediary? It means broker, agent, or any other person by whatever name called. So the terminology used is irrelevant. What is important is intermediary is the one who arranges or facilitates supply of goods, service, or both, or even securities. So it may be good service or it may be something which is neither goods nor service, but is security. What this person is doing, arranging or facilitating supply. But what is important is that this person himself is not involved in making the supply. So this person is not one of the chain of the supply. So this person should not be the person through whom the goods or services are supplied. So this person should be acting only as a person who is connecting the two people, the supplier and the recipient. The supply is happening directly between the two. It is not happening through this person. That person is intermediary. Another interesting definition and important is the definition of non-taxable online recipient. This is relevant for all the OIDER online gaming services coming from outside India. So these services are taxable to the supplier who is sitting outside if the recipient is a NTOR. What is NTOR? Non-taxable online recipient. So it basically means you and me who are in their individual capacity consuming some online services, either some OTT platform we have subscribed to, or we are using or playing some games, downloading some uh, video, audio, any type of literature. All this comes in the online services for which we are going to study. What is important is when this will be taxable to the foreign supplying company or supplier is when the recipient is non-taxable online recipient. So who is this person? It means that the person is unregistered and the person is receiving online information or online database access or online database retrieval services, and this person is located in India. So the recipient is in India, the recipient is unregistered, and this recipient is receiving online information, or this recipient is accessing database online or retrieving database online. For the purpose of this class, expression unregistered includes person who is solely registered under section 24(7) of the Act, that is for the purpose of TDS-TCS. Now, location of recipient, supply, location of supplier, I'm not reading this. We have already dealt with in detail when we deal with place of supply. Now, what is this? Online information and database access or retrieval services. These are called as OIDER services because for this only we have that specific provision that supplier is outside, recipient is inside India and is NTOR. What is OIDER service? It means service whose delivery is mediated by information technology over internet or electronic network. So first thing is that these services are those which are delivered via. Now the word mediated, I am just substituting by the word via some information technology network. So like internet or any other electronic network. So it may be coming through net, it may be coming through some leased old lines, whatever. So any electronic network is used and the delivery is mediated by some information technology network. So important point is in order to be online information database and access retrieval services, the basic criteria is how it is delivered to you. Means what? Whatever is the nature of that supply, that particular supply should be such that its delivery is happening, is undertaking place through some information technology network. Second part of this definition is and. Now this part has undergone some amendment. It says the nature of which render the supply impossible to ensure in the absence of the technology. So second part requires that first is it is mediated through the information technology network. Second part says the nature of which renders the supply impossible to ensure in the absence of technology. So until unless this technology is there, the supply could not have been possible. It means the supply itself could not come into existence. So both things are necessary. First, the supply itself is not coming into existence in the absence of the technology framework. Two, the delivery is happening over this or through this information technology network. Next part of this definition gives a clarificatory type of list as to what will be included. So it is not an exhaustive list, but it is like giving you an idea as to what we are basically referring to. So advertisements on internet, now just apply the above two criterion. One, it is delivered using the technology platform. Yes, it is impossible without the technology. Now, when we are specifically talking about advertisement on internet, we are not talking about any other physical advertisement or advertisement on television and all. We are specifically talking about advertisement on internet. This supply is impossible without the information technology. Similarly, cloud services, similarly, provision of e-books, movies, software, other intangibles, then providing data information retrieval or otherwise to any person, then online supplies of digital contents like movies, television shows, etc., then digital data storage and online gaming. Now you will agree with this list. So this is only an illustrative list, but this clarifies what they mean by the first two requirements. That one, it should be delivered using the information technology platforms, and the supply itself should be coming into existence using the technology platform. That is, it is impossible without the technology platform. Now, with this backdrop, we start with some discussions relating to taxability of import export, specifically from the perspective of GST law. Now, before we go to the GST law, as we all know, any taxation law has its genesis in the constitution. So we first refer to constitution to understand that whether constitution permits us to levy taxes on anything which is coming from outside India, which we call as import. So for this, the supporting, one of the supporting, if I can say, entry you find in Article 269A, which says that this article constitutionally authorizes supply of goods or service in the course of import into the territory of India, and it says that such import shall be deemed to be supply in the course of interstate trade or commerce. So for import of goods, when these things are coming from outside India, the person who is getting the revenue is sitting outside India. Still, because of 269A, the constitution says that we have to deem that it is happening in the course of interstate trade commerce. Therefore, import export of goods is interstate supply and obviously then liable to IGST. Next, supply of goods or service to SEZ or SEZ developer is also treated as interstate supply, and the same is also liable to IGST. Then, in case of goods, importer pays IGST, and in case of service, importer pays IGST under reverse charge. Now, in both cases, importer only pays, but the difference is importer of goods is paying IGST but not under RCM. It is paying IGST as per the specific proviso provided in section 5.1, and importer of service is paying IGST because the import of service is covered under notification, RCM notification issued under 5.3. So this is the difference between import of goods and import of service. In respect of import of wider services, now who is importing unregistered non-taxable recipient, that is what we discuss as NTOR, and the supplier is located outside India. In such cases, the supplier is a person liable to make payment. It means it will be under forward charge even though the supplier is outside. Now, for exercising control, such supplier is mandated to take a compulsory registration in India or to appoint a person in India who will be responsible for all the liability discharge. IC code, PAN of an entity is to be used as IC code, or if importer is registered under GST, is required to declare GSTIN and PAN is part of GSTIN. Fine. Now statutory provisions. Section 5.1 is the charging section of IGST, which provides that there shall be levied a tax on interstate supplies. Now what is important is this proviso, because this is creating a specific charge on import of goods. Now you'll say, sir, why there was a need to create a specific charge on import of goods? Is it not covered under 5.1? Answer is it is covered under 5.1. But then why this proviso required under 5.1? Because we want to shift the levy, the collection, the time of supply, everything to customs law. Means what? you are going to pay IGST on import of goods, but all the what you can say, the levy and all the collection mechanism would be as per customs law. Means what? The nature of tax is GST, that is IGST, but the mechanism is of customs. Hence, in case of import of goods, which is covered in proviso 251. So proviso 251 is exclusively covering only IGST on goods, and which goods which are imported into India. So proviso is only covering import of goods, and it says that the levy, the collection, everything in relation to import of goods of IGST will be as per the provisions of customs law. Now in customs, you have the main customs act, and the types of duties are mentioned in customs tariff act. So it is saying it will be in accordance with section 3 of the customs tariff act, obviously read with section 12 of the customs act, which is the main charging section. Now what is relevant is why we needed a proviso, because the levy, that is when the tax would become or the tax would trigger, will be decided by customs law. The collection mechanism will be custom law, including the valuation and also the time of supply. Everything will be decided by the customs law. So only the nature of tax is IGST, but even the value will not be the value as per the GST law. Now, interestingly, all international transactions would be in foreign currency. So in fact, the conversion of euro to Indian rupees, dollar to Indian rupees, dirham to Indian rupees will also be governed by the specific provisions of customs law. So for import of goods, when you want to compute IGST, you don't have to come to IGST Act. Only the rate is taken from the rate schedule of IGST notification. Everything else will be as per customs law. But this is not the case in case of import of service. So for import of service, which is covered in RCM notification because of 5.3, everything is governed by IGST Act. Now, further, what is given about import of goods? Section 7.2 of IGST Act says, supply of goods imported into India till they cross the custom frontiers of India shall be treated to be supply in the course of interstate trade or commerce. So, supply of goods, that is import of goods, if I can use this word now, is always to be regarded as interstate supply. That is already mentioned in Constitution also, and it has now been incorporated in the IGST Act, White Section 7.2. Then place of supply provisions for import of goods. For place of supply, Section 11 of the IGST Act says the place of supply for import of goods shall be the location of the importer. It is not the place of import. So the goods may be landing at Bombay port, but if you are an importer from Tamil Nadu, the place of supply will be your Tamil Nadu address, so that whatever IGST you are paying at the time of import at Bombay port, that should come in your Tamil Nadu registration as credit, and you should be eligible to utilize the credit. Had the place of supply of import of goods been the place of import, that is in my example Mumbai, Maharashtra, and if you are a dealer registered in Coimbatore, Tamil Nadu, you will not be getting the credit. So to avoid this, this particular point has been specifically brought in. I hope this is clear to everyone. Anybody has any questions up to this point, please feel free to put across. Yes, Swaminathan Beda, you have any questions? Okay. Now, since Section 5.1 proviso is referring to Section 12 of Customs Act, So Section 12 of Customs Act is what? It is that provision which creates a charge on import of goods. Now, what does Section 12 says? Except as otherwise provided in this act or in the law for the time being in force, duties of customs shall be levied at such rate as may be provided in the Customs Tariff Act or any other law for the time being in force. So, the Customs Charging Section 12 says that whenever there will be import of goods, you will pay the customs duty at the rate specified in the Customs Tariff Act or any other law for the time being in force. So this is where the IGST is impliedly covered. Thereafter it says the provisions of subsection 1 shall apply in respect of all goods belonging to government as they apply in respect of goods not belonging to government. In one of my previous discussions, I had mentioned that a comparison between income tax and GST law, or for that matter, direct tax and indirect tax laws, is that indirect tax laws even covers government. It keeps government at par with any other person. So whenever a government engages in any taxable event of indirect tax, it is equally liable to indirect tax as if it is any other non-government or private organization. So that is very well clear from this subsection 2. Now, provision for collection of IGST on import of goods and warehouse goods sold from custom warehouse, as also for determination of their value under section 3. Now, what is this particular point? Now, for this point, you have to understand few things. First is that here the charging section says that duties of customs are levied at the time when the goods are imported into or exported out of India. So customs duty triggers whenever there is import export happening in India. Import is defined to bring goods into India from a place outside. However, as I mentioned earlier, literally it may mean that the goods come into the physical territory or territorial waters of India. That is correct. But for all practical purposes, as brought out in different judgments of the past periods, it has been established that for all practical purposes, the levy of customs duty will trigger not on goods entering the physical boundary of India, but on the goods being cleared by the importer from the customs by following the specific procedure, that is filing bill of entry. So once this is clear, so let us understand a practical scenario. You are an importer from Coimbatore, Tamil Nadu. The goods are landing at the Bombay port because the ship which is coming will be coming only to Bombay port. So that is okay for you. So what you do is you have appointed a CHA, that is custom house agent, who will be doing the entire import procedure on your behalf. Now in this particular case, when this CHA is clearing the goods, physically what is happening? The goods or the ship, I should say, has entered into India today. Today is 4th of November. The goods will be unloaded and will go into the custody of customs and the designated port trust authority. Let us say this will happen in next 3 days, so it will be 7th of November. You as an importer will be filing the bill of entry. You have filed the bill of entry, let us say before the arrival of this ship on 1st of November itself. Now in this particular case, the custom law allows you to either take the goods immediately, which is called as clearance for home consumption, or it allows you to defer the clearance. But how? Because within 30 days, the goods should be cleared from the port trust. So for this, the custom law has a provision called as warehousing, whereby you can get your goods removed from the port trust and still keep it with the customs only. How? So customs has designated warehouses, has licensed certain warehouses. Some are public, some are private, whereby you can opt for the option of removing the goods from the port and keeping it in these custom warehouses. So let us say your custom warehouse is falling in Chennai. So what you can do is you can ask your CHA to get the goods cleared from the Bombay port, but not cleared for home consumption. That is not for taking or bringing it to your factory, but for simply removing it from port Mumbai port, and still keeping it with customs in the customs port in Chennai. Sorry, not port, custom warehouse in Chennai. Now, in this particular case, your CHA files a bill of entry whereby the goods are removed from Bombay port and brought into the customs warehouse at Chennai, where they will be kept until you again file a bill of entry for getting it cleared, which will be called as ex bond bill of entry for home consumption. Now, in this particular case, a question that comes is how the valuation will be done, on what value the custom duty will be triggered, and secondly, when the custom duty will be triggered. Now, here, customs law is very different from the GST law. GST law generally triggers whenever, let us say, in this case, the goods have been purchased by you, or the payment for the goods have been made by you. Any of these things happen, the GST would have triggered because GST is on supply. However, since we just discussed in Proviso 251 that with respect to import of goods, the customs law says that the GST law will not apply when it comes to the levy collection and valuation and even the timing. What will apply is the customs law. And customs law, as we just discussed, says that there is no levy triggering at the time of physical entry into India. It will trigger only when you clear from customs. Now, in this case, even though the goods are removed from Bombay port, but still they are with customs. How? They are kept in Chennai warehouse of customs. So still they are under customs control. Hence, technically there is no clearance and hence there is no levy of customs. Now, since there is no levy of custom under section 12, equally there is no levy of all those other taxes like GST, IGST to be particular, because IGST levy and collection both are to be done as per customs. Now, since customs law has not yet triggered the point of collection, point of levy. Hence, we will also not create any levy of IGST. Now, in this particular case, the question is when this levy and collection will trigger, and then what will be the rate, what will be the value. For this, we have to understand the customs law a bit in detail. So, customs law says that in case of warehouse goods, the levy will trigger when the importer files the ex bond bill of entry for clearance for home consumption. So now the goods are physically lying in the Chennai port customs warehouse, sorry, and you file ex bond bill of entry in February 2026, after 4 months from today. And through this bill of entry, you want to clear the goods for your factory in Coimbatore. Now, when you file this, so goods entered into India today, that is 4th November, but the trigger for paying customs duty and the parallel IGST is happening in February as per the custom provisions. Now, the another question comes is how to do valuation. For this, section 37 of the IGST, sorry, of the Customs Tariff Act provides that an article which is imported into India shall in addition be liable to IGST. So levy of IGST is triggered through section 37 of Customs Tariff Act. And what it says, this is as per section 5 of the IGST Act, which we just saw. And it will be as per how the like articles are being levied with IGST whenever the supply is happening in India. So it is just creating a charge. Now, what is very important is it says the value will be determined under subsection 8, 8A of this particular act. Now, what does subsection 8 says? So, whenever goods are being cleared from the custom bonded warehouse and the custom duty and the IGST triggers, how the valuation will happen. So, firstly, the valuation will be as per the customs law and not as per the GST law. So, firstly, the valuation is as per the customs law and not as per the GST law. Now, for that, when we deal with customs, you study in customs that there is section 14 read with the valuation of import goods rules. So you can simply call it as import valuation rules using the provisions of section 14 and import valuation rules, you determine the value. But this is not sufficient because that value is for levying basic custom duty. Now, what is the value for levying IGST? So, section 3.8 provides that the value will be the value of imported goods as per section 14 of the Customs Act plus any customs duty which is chargeable on that article as per section 12. Just a minute. Sorry. So, the customs valuation which is provided in section 14, which will be applicable for levy of basic customs duty, will be further added with the duties which are leviable as per section 12 of the Customs Act and any sum chargeable on that article under any other law for the time being in force. So interestingly, for the purpose of levy of IGST, you have to find out the customs assessable value. To that, you will add the customs basic duty, basic custom duty, the custom social welfare surcharge, plus if there is any protective duty under customs like the anti-dumping duty, etc. The total of this will be the value that becomes liable for IGST, and if there is any compensation cess of GST, the compensation cess is also calculated on this value. Now, interestingly, if I link it with something under the GST law, the valuation is provided under section 15. And section 15 bracket 2 clause A says that for the purpose of GST law, the value of any goods or service will include any taxes other than the GST taxes which are levied on those goods services. Now, if I read this part, section 3 bracket 8 of the Customs Tariff Act and link it with the GST valuation, you will find the logic of this particular clause B. So clause B of 3.8 of the Tariff Act says that it says that whatever is the customs duty or any other sum chargeable on that article under any law other than obviously GST law will be added to the customs valuation. So this is aligning this particular point with section 15 of the GST valuation provisions. Now, interestingly, a new provision was added. This is 3 bracket 8A. Now, let me explain when this 3.8A triggers. So, you imported the goods. The goods are presently lying in the Chennai custom bonded warehouse, and you may remove it, as I said, let us say in February. But before that, somewhere in December, near December end, I approach you saying that I want to purchase goods from you, and the goods are the same goods which are right now presently in the warehouse. So you inform me that these goods have been imported by you, but they are kept in warehouse. So you ask for a time of 10-15 days so that by that time you can complete the custom procedure, get the goods clear, bring it to Coimbatore and give it to me. I said, fine, if your goods are kept in customs warehouse, and customs warehouse, when you study the warehousing provision, you find that there is a time limit that maximum up to 1 year and also extended by some time, you can keep the goods in custom warehouse. Now, I also do not want the goods immediately because I do not have the physical space in my factory to store so much of goods. So I'm happy that your goods are lying in customs. Also, that the customs time limit of 1 year is still not elapsed. So what I tell you is, boss, do one thing. Instead of you physically removing the goods and giving it to me again, I'll have to search for a warehouse because I too do not have the space. Let us do one thing. You sell me these goods on as is, where is basis. So what is as is, where is basis? The goods are kept in the Chennai custom bonded warehouse. Let it be there. I will purchase it on as is, where is basis. So don't clear the goods. Let it be in the bonded warehouse. Now the customs provision also allows such type of transaction whereby a person whose goods are kept in the warehouse can, through transfer of document of title on those goods, sell, transfer the goods to somebody else, and then that new buyer would be the person who would be treated as importer, and all the compliances, including the issue of the warehousing bond, etc., has to be done by this person. So you sell these goods to me, I issue the custom bond, you get your bond release, all those procedures are done. And now the goods are under my ownership, but physically they are still in the custom bonded warehouse. Now, first point is, when you sold the goods to me, definitely would have sold it with some margin. First question is, what is the GST implication on you when you are transferring these goods which are lying in custom bonded warehouse? Answer is Schedule 3. If you see Schedule 3, Entry 8, it specifically deals with this scenario. To be more specific, Entry 8, Clause A. So I'm talking about Schedule 3 of the CGST Act. In Schedule 3, we deal with those activities transaction which will be treated neither as supply of goods nor service. In short, no GST is triggered on them, no GST is attracted on them. And in that Entry 8A says that when such custom warehouse goods are sold without getting the goods cleared, that is on as is, where is basis, then in such cases, it will not be regarded as supply. So firstly, when the goods are sold by you to me on as is, where is basis without getting it cleared from the customs warehouse, it will be a no supply transaction for you. So firstly, in your hands, there is no GST liability triggering on this particular supply of goods. First point. So there is no question of looking at IGST Act. There is no question of looking at Customs Act. Nothing is getting triggered, including the customs law, because customs law is also not getting triggered, because customs law is triggered only when the goods are cleared. And since we have only sold between ourselves, the goods are transferred through document of title. There is no physical release of goods from the custom warehouse. So there is no clearance from customs, and hence the custom duty is also not getting triggered. So both laws are running parallel. Now comes the next point. Now in this particular case, when I go for clearance, let us say now I go in February for getting these goods cleared. Again, customs law even provide that we need not clear the whole consignment at once. Within the warehousing period provided, I can clear the consignment in small parts to the extent whatever I require or whatever space I have in my factory. But let us say for simplicity, I am getting it cleared entire consignment in February. Now the question is, will there be a customs levy? Answer is yes. Now there is a custom levy in lines with Section 12 of the Customs Act, read with the varied case laws and the other provisions. Now the levy will trigger, and as per the time of supply provisions of the customs law, the liability will be triggered when I file the bill of entry. Now here, when this bill of entry is filed, the question will come first, which rate? Which rate means rate applicable on which date, because the goods came into India on 1st November. First bill of entry was, goods entered into India on 4th November. Bill of entry first was filed on 1st of November. It was filed to transfer the goods to the Chennai bonded warehouse. The goods came to the Chennai bonded warehouse on 7th of November. And today means in February, they are getting cleared by filing the X bond bill of entry. The question is, which dates custom duty rate would apply? The answer is the rate applicable on the date of filing this X bond bill of entry, which is February 2026. So that day's rate would be applicable, and because of this interlinking provisions, even the IGST rate of that day will apply. So you will check customs duty rate, IGST rate of February 2026. Okay. The second question will come rate of exchange, because the original value is in dollars. We need to convert it to rupees. For this, the custom law says rate of exchange will be the rate of exchange on the date of first bill of entry. That is not changing. So the rate of exchange always remains the rate of exchange of first bill of entry. Rate of duty changes depending upon what the provisions of customs law provide for the time of supply. So that in this particular case will be the date of clearance by filing the ex bond bill of entry. So ex bond bill of entry, that is February 26th day rate of duty, and 1st November 2025's rate of exchange is what is to be taken. Now comes the last question, value. Now, interestingly, when you had imported, your purchase bill or the import bill has a different value, but the price at which you have sold me is definitely going to be different because there will be some markup. Now, the question is, which value is to be adopted now for computing the IGST when these warehouse goods are cleared after being sold by the original importer to some new party? For this section 3 bracket 8a says that we will take higher of the two values. So what it says, where the goods deposited in a warehouse under the provisions of customs are sold to any person before clearance for home consumption or export under the said act, the value of such goods for the purpose of calculating the GST shall be, where whole of the goods are sold, the value determined under section 8, that is above, or the sale value of such goods, whichever is higher. And even where part is sold, the same rule applies. Provided that where the whole of the warehouse goods or any part thereof are sold more than once. Now let us say you sold to me, I further sold it to, let us say, Maniji. Maniji further sold it to Ajiji. So before its final clearance, the goods were sold multiple times. Then this same rule will be applicable by taking which transaction value? So original purchase import value compared with which transaction value? Transaction value of the last of such sale. So in short, the last transaction value before the goods are finally getting cleared or removed from warehouse. That sale value compared with the valuation as we derived above, whichever is higher. Generally, it will be the second transaction value or the last transaction value, which will be the higher. Provided further that in respect of warehouse goods which remain unsold. Now, why you have to find out the value for unsold? But if it is unsold, no GST, no customs. Sorry, this is where customs law is different. So even if you do not clear the goods and the time period until which the goods can remain in the warehouse is expired, still there is a duty liability triggering on the goods. That is where this proviso is applicable or useful. So provided that in respect of warehouse goods which remain unsold, the value or the proportionate value as the case may be of such goods shall be determined in accordance with provisions of section 8. So this is how entire valuation mechanism will be applicable. Section 311 of Customs Tariff Act, it says what? The duties or tax or excess as the case may be chargeable under this section shall be in addition to any other duty taxes as may be imposed under this act. So they are talking about which duty says. So they are saying that whatever tax or duty is applicable will be in addition to any other tax duty applicable. So basically we are talking about the compensation cess here. Now coming to next special provision, that is under 14 of the IGST Act. Now this section is applicable for whom? So there are two sections, section 14 and 14A of the IGST Act. Both these sections are applicable to a similar scenario, that is where the supplier is sitting outside, the recipient is inside, and we are talking about the scenario where the recipient is NTOR, that is non-taxable online recipient. Now, why this importance is placed on non-taxable online recipient? Because generally whenever import happens, it is the importer who is liable to pay tax. But here, since the importer, that is you and me, who are availing either the OIDER services or the online money gaming. We are common citizens, and since we are unregistered in India, so for us, only for such one-off transactions, registering and paying tax may be not possible. So for us, Section 14 and 14A have been introduced. 14 was there originally. 14A is introduced very recently after the amendments relating to online money gaming were introduced. Now, what does Section 14 says? 14 says where supplier is of OIDR service. 14A says where the supplier is of online money gaming. And these suppliers are sitting outside. Recipient is in taxable territory, that is inside, and the recipient is non-taxable or unregistered. What does subsection 1 says? The supplier of online money gaming as defined in this section of this clause of this section of CGST Act and who is not located in India shall, in respect of the supply of online money gaming by him to a person in taxable territory, be liable to pay IGST. So they have made it forward charge. Since the importer, that is you and me, are common citizens not registered here, so we are not saddled with the responsibility of paying IGST. It is the supplier. But since the supplier is outside, some more control mechanism is required. What is that? For the purpose of complying with provisions of subsection 1, that is making the supplier liable, the supplier shall obtain a single registration. Now, this is interesting. Why this point is given single registration? Because under GST law, we have state-wise registration. Now, this supplier is a single supplier sitting outside India and having some app, and through that app we all are availing the or enjoying that online money gaming. We are participating in different online gaming contests, and this supplier is sitting outside. Now for this supplier it will be difficult if you ask them to take registration in different states. So for them a rule has been made that they can obtain a single registration under a simplified registration scheme referred to in subsection 2 of section 14. So a simplified scheme has been derived for them. For all other people who are in India, we have a different mechanism of registration, but for these people, there is a simplified mechanism. Now, provided that any person located in taxable territory representing such supplier for any purpose in the taxable territory shall get registered and pay the integrated tax on behalf of the supplier. So either the supplier itself should take registration in India, or any person who is already located in India can be representing the supplier for the purpose of the law. Provided further that if such supplier does not have a physical presence or does not have a representative, he shall appoint a person in the taxable territory for the purpose of paying the tax, and such person shall be liable. Now, until unless this supplier appoints someone, the supplier will not be allowed to operate in India. No, but Agita, in even in case of online money gaming, where the recipient is registered, still reverse charge will not apply. I'll tell you why. Because the reverse charge applies only to import of service. I explained this at the start. And if you remember, online money gaming is now categorized or classified as a specified actionable claim, and actionable claims are all supply of goods. So indirectly, online money gaming becomes goods, and for import of goods, there is no RCM. So even here, if the recipient would have been registered, the liability remains on the supplier. So that is why if you see this first part also, it says that shall in respect of supply of online money gaming made by him to a person in the taxable territory. So here they have not used the reference of unregistered person. This is used in case of OIDR services, which is in section 14. So section 14, where we talk about supply of OIDR services, over there the requirement is recipient is unregistered. But when we talk about online money gaming, the act does not make a requirement that the recipient should be registered or unregistered, because supply of online money gaming is today classified as supply of goods. And in case of supply of goods under the IGST Act, section 5(1) proviso applies. So it is not RCM. So whether it is registered or unregistered, here they have made the liability always on the supplier. Subsection 3 says, in case of failure to comply with the provisions of subsection 1 or 2, either supplier of the online gaming or a person appointed by such supplier or both, not notwithstanding anything contained in 69A of the IT Act, any information generated, transmitted, received, or hosted in any computer resource used for supply of online money gaming by the supplier shall be blocked. So we have something called as METI. Ministry of Information Technology something. So that ministry is regulating all online apps and everything. So sometime back when we heard that some Chinese app have been banned, TikTok is banned, and all these things are banned. So that is all done by METI. So if the online gaming companies do not follow the above registration and compliance of law, the simplest thing which the government of India will do is simply block their apps so that they will not be able to make supplies in India. Just a minute. Yes, students. So, yes, Bombay dying case law. Correct, Geeta. So these are firstly the provisions relating to import of goods. So here in detail it is provided. Now an interesting point comes that when this proviso to section 5 of the IGST Act says that for import of goods, we will follow the customs law for levy and collection. A question comes, what will happen in case of import of intangibles? So like we all know, intangibles, for example, patents, copyright, trademarks, these are also categorized as goods. Now, if some foreign person's patent I am buying, so I get the patent transferred in my name. Now, in the eyes of law, it is also supply of goods. But interestingly, all this is happening through documents. So there is nothing coming from the uh, ship or which will be going to customs. So it is happening only by way of transfer of documents. Now, in such a case, how customs will come into picture? Because proviso to section 1 says that in case of import of goods, levy, collection, everything will happen through customs. So for this particular paragraph is important. In case of intangible goods, it may not be possible to levy and collect IGST on imports in the said manner. Said manner means as per the custom law, as the goods may not be physically crossing the custom barriers, because you transfer intangible assets by signing the contracts and agreements. That's it, and registering them in your name. Resultantly, the government is empowered to notify certain goods for whom proviso to 5(1) may not be applicable for levy collection, and in whose case IGST shall be levied and collected in manner 5(1) only. So, For such types of goods, the government may use the power to notify. Further, supply of online money gaming has been modified for the said purpose. This implies that import of specified actionable claim of online money gaming will be taxed under the IGST as import of goods, but without applicability of the customs law, because these things do not come through the custom frontiers. Point where IGST is levied on import goods, it will be the point where customs is levied. And where customs is levied? When you file the bill of entry for home consumption. So even the IGST levy gets delayed till the levy of customs happen. Valuation, as we discussed earlier, the value will be as per the customs provision and not the GST provisions. Now, whatever value is derived from the customs, on that you add all the custom taxes, the basic custom duty, custom cess, all the protective duties, and on that cumulative value, we calculate IGST also. And if compensation cess is applicable, we even calculate the compensation cess. So this is the formula: value as per section 14 plus basic customs plus any other duty leviable, which is all these types of duties. So wherever the goods are leviable to GST compensation cess, the same is collected on the same value. In other words, IGST paid shall not be added, because in case of domestic transactions also, wherever cess is applicable, you don't add the GST portion to compute cess. Cess is also calculated on the same value on which GST is calculated. Now, in cases where goods imported are liable to these duties, what duties? Anti-dumping, safeguard. Value for the purpose of calculating IGST and GST compensation cess will be after adding these duties also. So all of these duties levied under customs will be added, and this cumulative value will be taken for charging IGST and even cess. Then this point we just discuss in details, where the goods are deposited in customs, how the valuation will be done. So for goods deposited in custom bonded warehouse, if the original importer is withdrawing, the value will be the value as we discussed above. But if the goods are sold before its clearance, then it will be higher of these two values. Now coming to another transaction, that is taxability of high C sales. What are high C sales? So let us say your goods are being imported. They are still in transit. So your ship has not touched the Indian waters. It is still in the high seas. I approach you that I want to buy some goods from you. You say that yes, you have already ordered for those goods, but the goods are still in high seas. It will take more 10 days for the ship to reach India, and then more 15-20 days for complying with all the custom provisions. So I said, fine, do one thing. I will comply with the customs provisions. You sell me the goods today. So today, when the goods are physically in the high seas, the ship has not entered India. I want to purchase these goods. So you agree to that. We land up on a price. We negotiate a price, and on this price, you sell these goods to me. Now, a question comes that what will happen when the tax angle comes in. So when we look at this transaction from the tax angle, the first question is what will happen under customs. So today you are the importer, but the moment you transfer the document of title, I become the importer. In fact, if you see the definition of importer, this is the beauty. The definition of importer is so open that anybody will be importer. So it is not only the person who has actually imported, it can be any other person. So from customs point of view, today there is no liability. The liability will be triggered only once when these goods will be cleared from the customs. So today there is no custom implication. But then comes the second question, what about GST? Because there is a sale happening. Both of the parties, you and me, are in India. So what will be the nature of this supply, whether it will be C plus S, whether it will be IGST or what? So for this, in the initial period when the GST law was introduced, there was a lot of confusion. Later on, Schedule 3 was amended to include Entry 7. And Entry 7 specifically covered this, sorry, Entry 8B, not 7, sorry, Entry 8B specifically covered this in Schedule 3, treating the high C sales as outside GST, because it is treated neither as supply of goods nor as supply of service. Now, another interesting issue which you should know and remember is that there is a section 17.2 under the GST law. This 17.2 read with rule 4243 of the GST law provides that whenever you are engaged in making taxable as well as exempt supplies, you have to do proportionate reversal of your common ITC. Now the question came, what about the transactions which are mentioned in Schedule 3? Whether for those transactions also you have to do proportionate reversal? So the original answer is no. So since transaction in Schedule 3 are to be regarded neither as supply of goods nor as supply of service. They are not supply in the first place. So, as per the general connotation, they are not even exempt supplies. And since they are not exempt supplies, their value should not be considered for the purpose of Rule 4243 reversal. However, we have section 17 bracket 3. So 17.2 is what? 17.2 is asking you to do reversal. 17.3 is providing on what value you should do the reversal or what value should be considered as exempt supply value. Here, interestingly, 17.3 has included in the deemed definition of exempt supply certain transactions which are not supply in the first place only for the limited purpose of Rule 4243 reversal. Now, in this relation, we have to analyze what will happen for the above transactions which we discussed, like the goods which are in custom warehouse are sold or the goods under in high C sales are sold. What will be the implication of this? So for this, the answer is value of high C sales is not to be included, important, not to be included in the value of exempt supply for the purpose of reversal under Rule 4243. So high C sales have been excluded while doing the reversal. However, if we talk about warehouse goods which are sold, interestingly, what is given? Value of such activities or transaction as may be prescribed in respect of in-bond sales as specified in Schedule 3 is included in the value of exempt supply for the purpose of reversal under Rule 4243. So this is an interesting point. So we are talking about the same genre of transactions. All these are transactions happening in the course of import before the goods are cleared into India. So one is once the goods come into India, they are lying in the custom warehouse, and while the time they are in warehouse, they are sold on as is where is basis. Second, while the goods are still in the high seas, they are sold. And then there will be a third one, which will be even before this. Now, when the goods are still in the high seas and they are sold, or the goods have landed in India and they are in custom bonded warehouse and they are sold, in both cases, it is treated as neither a supply of goods nor a supply of service via Schedule 3. But the difference is for the purpose of reversal under Section 17.2 read with Rule 4243, there is a specific explanation given in 17.3 which says that certain supplies will be deemed to be exempt. Now, interestingly, the goods which are in custom bonded warehouse are sold. There may be no supply for levy of GST, but the value will be treated as exempt supply, but for the limited purpose of reversal of ITC under Rule 4243. But the same thing does not apply to high C sale transaction. For high C sale transaction, the value is not considered as exempt supply. So high C sale transaction value will not include in exempt supply for the purpose of 4243 reversal, but regular supply while the goods are in bonded warehouse will be considered. So these are some important comparative points that you have to understand. Now, what we discussed above that while the goods are in custom bonded warehouse, if there are 2-3 sales before they are finally cleared, you will take the last sale value. Similarly, while the goods are in high seas, if again there are 2-3 sales before the goods reach India and they are cleared. The question is, while clearance, who will be paying the duty? Who will be doing all the compliance? It will be the last buyer. So if you imported the goods, I purchased from you, Manishji purchased from me, Ajitji purchased from Manishji. So when now these goods, all these sales happen while the goods are in high seas. So finally now Ajitji is going to clear the goods. So Ajitji will be doing all the compliance of clearance, and then Circular 33 dated 1/8/17 has clarified that importer, last buyer in the chain, would be required to furnish the entire chain of documents. So right from first document of original invoice, high C sale contract, details of service charges, commission, etc., to establish a link between the first price and the last price. Then we go a step even back, third country shipments. What is a third country shipments? Again, I'll give you a practical example. Today, there are some sanction game going on by US, and presently India is saddled with some sanctions. But the same sanctions are not on other countries. So let us say we take example of Bangladesh. Now, I have got some export orders from US. But if I supply the goods from India, there is a challenge that it will be saddled with some huge, some 50% of 25 plus 25% of this tariff and whatever penalty or whatever they are saying, because of which my goods are costly. So my buyer is slightly not comfortable buying from. But then I contact with one of my colleagues or one of my similar business friend in Bangladesh. And since Bangladesh is not saddled with such high sanctions, so the prices for the goods which will be going from Bangladesh is much competitive. So what I do is I take the order, but instead of I supplying from India, I ask the Bangladesh person to do the supply. So what will happen? The goods are directly going from Bangladesh to US. In this particular case, what will be my position in both customs law and GST law? Now, firstly, let me tell you what will happen in my books. In my books of accounts, understand this, I'm first showing purchase from the Bangladesh supplier, and then I'm showing a sale to the US buyer. Now, in this case, in my books, there is a purchase and a sale entry. First, from the perspective of customs law, what is the tax implication? Answer is no tax implication, because the goods neither physically entered India, so no customs import implications. Neither the goods traveled physically outside India, so no export implications. From customs law, no implication at all. Now, interestingly, what about GST law? So originally there was a lot of hue and cry, lot of confusion. So ultimately, Schedule 3 was amended and all the above two entries, and this entry was also introduced. This entry was introduced in entry in para 7, whereby it said that a third country shipment or a triangular trade, which is a common practice, whereby the person sitting outside India, let us say in this example, it is suppliers in Singapore, is directly sending goods to the buyer who is in US, and I am the in between connecting party in India. In such a case, this transaction is a third country shipment, or I call it as out and out transaction. This is covered in para 7 of schedule 3, and because of which it is considered neither supply of goods nor supply of service, and hence no GST implication. Next question will come. What about the reversal, whether this transaction would be considered as my exempt supply? Again, it is clarified, it is not considered as exempt supply. So within schedule 3, there are few transactions which are considered as exempt supply, but others are not. And with respect to import, we have three transactions. First, warehouse goods sold, high sea sales goods sold, or third party shipment. Now, in these cases, only goods which are lying in warehouse, if they are sold, their value is considered as exempt supply, but the other two are not. If somebody wants to understand the ideology behind this, so these two transactions are happening on foreign soil. High sea sales is also not happening on Indian soil, and third party is also not happening on Indian soil. But while the goods are in custom bonded warehouse, though in the eyes of custom law the levy has not triggered, but if these warehouse goods are sold by one person in India to another person in India, the transaction is happening on Indian soil. The goods are physically in India. Hence, they have considered this as exempt supply. This is what is the ideology. Then, what will happen if SEZ is importing goods? Now, we all know that when SEZ export goods, it is treated as export and it will be zero rated. But what if SEZ is importing goods? Now, here there is an old clarification in the customs law itself, which says that where goods are imported by a unit or developer of SEZ for their authorized operations, they will be exempted from the whole of IGST. Is this clear? Next, what will happen where goods are imported by EOU? So, EOU, which are also called as export-oriented undertakings or 100% export-oriented undertakings, they have some reliefs. What is the relief? They are allowed duty-free import of goods. But interestingly, there is something which need to understand. Exemption from IGST will be subject to fulfillment of specified conditions. So EOU is allowed duty-free imports. So it means customs duties, IGST, GST compensation cess, everything is eligible. But the IGST component is eligible subject to some specified conditions. What will happen when a person traveling from outside India coming into India is carrying baggage? Now we all know that the baggage is again having some exemption to certain extent, which is covered in the baggage rules. But what if you are carrying baggage in excess of the exemption limit provided in the customs baggage rules? So custom duty is also applicable. What rate? The custom duty on such goods is applicable at a rate of 35% unless otherwise provided, and also applicable welfare surcharge cess, social welfare surcharge. Sorry. In this case, the question is, what about IGST? So answer is passenger baggage is exempt from IGST and compensation cess. So there is no GST on the baggage part, whether within the limits or exceeding the baggage rule limits. If it exceeds the baggage rule allowance or limit, only the customs duty component is applicable, but IGST or the cess is not applicable. Now, taxability of online gaming. Now, online gaming is divided into two parts: online money gaming and all other online gaming. Now, firstly, what is online money gaming? So, online money gaming is that online gaming where, so firstly, what is online gaming? Wherever you are playing game through any internet or any electronic platform, that is online gaming. Now, where in this online gaming, there is some money stake, and the stake is in such a form. So, you are participating in some competition, you are participating in some event whereby whatever money you have put on stake, if you win, the entire prize money, the pool is coming to you. In that case, it is called as online money gaming, and where you are only making payment as a subscription so that you are entitled to play the game, or you are making payment so that you can buy some online life or some sword or something, then that is simple online gaming. Online gaming is part of services, it is taxable as services, but online money gaming, being covered as specified actionable claim, is taxed as goods. Now, we are concerned with online money gaming in this section 14A, where we studied about also where the supplier is outside and the recipient is inside. Now, in this case, what are the specific provisions? Where a person located in India receives online money gaming from a person located outside India, firstly, the supplier will always be the person liable to pay tax and it will be IGST. Secondly, we saw above, supplier will take simplified registration and will furnish return form GSTR 5A by 20th of the succeeding month. Further, overseas supplier should have a representative in India for any purpose. Such representative shall get registered and pay the IGST. In case the supplier neither has physical presence nor representative, then it will have to appoint a person in India for paying tax. Otherwise, the website or the app will be blocked. Now we proceed further to next part. Till now we were emphasizing more on the goods aspect. Now we come to the service aspect. Now interestingly, when we come to the service aspect, firstly, when we talk about import of service, you have to first check schedule, not schedule, section 7 of the CGST Act, which defines supply. In section 7, import of service get covered in all the three clauses 7(1)(a), 7(1)(b), 7(1)(c). It means import of service is given a very special treatment when it comes to the definition of supply, whereby if you fulfill all the conditions of supply, the import of service is a supply under 7(1)(a). Under 7(1)(b), where services are imported but for personal use, that is not in relation to business, still they are considered as a supply in 7(1)(b), other conditions being satisfied. And in 7(1)(c), where import of service are imported free from a person who is your own entity outside, in that case, the import of service is still a supply under 7(1)(c). So in other words, import of service becomes supply in all the three provisions of section 7. Now, how GST is levied? Now, section 5(1), which is the charging section, applies to all transactions of interstate supplies, and we already studied that import of goods and service as per Article 269A will be regarded as in the course of interstate trade or commerce. Now, 5(3) of the IGST Act says that for certain specified categories of supplier goods or service, both the tax shall be paid under RCM. Now, why this notification? We have a list of RCM under which import of service is covered. Alongside this, we have section 5(5) of the IGST Act, which says that again for certain specified category of services, the tax will be paid by the electronic commerce operator. 7(4) says that supply of service which are imported will always be considered as interstate supply. Section 9 of the IGST Act provides that where the location of supplier is in territorial waters, the location of such supplier or where the place of supply is in the territorial water, the place of supply shall be deemed to be the nearest coastal state. Then section 13 provides for place of supply whenever the supplier or recipient, any one of them is outside India, and we are talking about place of supply of services. So for that, you have to check section 13 for determining place of supply provisions. Now, this we were discussing earlier, section 14(1). It is a special provisions for payment of tax by a supplier who is supplying order services from a place outside India to a NTOR, that is non-taxable online recipient of India. In such cases, if the recipient in India is registered, then what Geeta was asking earlier, in this particular scenario, the person in India will be paying tax under RC. However, otherwise, where the person is unregistered, section 14 will apply. The IGST on such import will be paid by the supplier only. So what does 14(1) says? On supply of order services by a person located outside India and received by a non-taxable online recipient, the supplier of services located outside India shall be the person liable to pay IGST. Further provided that in case of supply of order services by any person located outside India and received by non-taxable online recipient, an intermediary located in the non-taxable who arranges or facilitates the supply of service shall be deemed to the recipient of such service from the supplier of service in non-taxable territory and supplying such service to the non-taxable online recipient except when such intermediary satisfy the following conditions. Now, what is this point? Now, this proviso is basically dealing with that where there is a supplier of order service who is outside India and it is received by a non-taxable recipient. Now, who is this recipient? An intermediary located in the non-taxable territory. And this intermediary further arranges or facilitates the supply of service, such intermediary shall be deemed to be the recipient of service from the supplier of service who is outside India. Now, in this particular case, the intermediary would be considered as the recipient if the following conditions are satisfied. First, the invoice or customer's bill or receipt issued or made available by such intermediary taking part in the supply clearly identifies the service in question and its supply in non-taxable territory. The intermediary involved in the supply does not authorizes the charge to the customer or take parts in its charge, which is that the intermediary neither collects or process payment in any manner, nor is responsible for payment between this, and the intermediary involved in the supply does not authorize delivery, and the general terms and conditions of supply are not set by the intermediary involved in the supply, but by the supplier. So basic idea is that where the intermediary is not having any control in this particular transaction, then in that particular case, the intermediary would be deemed to be the recipient. Now, the important part is 14.2. It says that the supplier of OIDER services shall, for payment of IGST, take a single registration using the simplified registration scheme. Further provided that the person located in taxable territory representing such supplier for any purpose in India shall get registered and pay IGST. And if such supplier does not have physical presence or does not have representative, he may appoint a taxable he may appoint a person in India for paying the IGST, and such person shall be liable to pay tax. So this is what is similar to what we studied in 14A. Now going to the details, taxability of import of service. So as I said, import of service is covered in all the three clauses. It is covered in 7.1A. If all four conditions are satisfied, that is, there is import, the import is of service, there is consideration, and the business test is satisfied. However, where the business test is not satisfied, that is where the import is for personal use, still it is covered in supply under 7.1B, and where it is without consideration, then it is covered in 7.1C with a condition that the supplier and recipient are interrelated. So service is getting covered in all the three clauses. So somehow it will be a supply. Now, what is import of service? So for this, three conditions are important. Supplier is outside, recipient is inside, and mainly the place of supply falls inside India. And this place of supply is determined by section 13. When all these three conditions are satisfied, only then we will call that transaction as import of service. Where any one of these conditions is not satisfied, especially this place of supply, many times this is ignored by people. People only see the two conditions. Supplier is sitting outside, recipient, that is me, is inside. And some one more condition which is not there in the law, but people checks that the payment is in foreign currency, though it is not the condition, but people check this. So when place of supply is not checked, and if place of supply is not falling in India, then as per the GST law, it cannot be import of service. Most importantly, for checking place of supply, you have to apply only section 13 of the IGST. That is what is important. Now, who is the person liable to pay tax? Except in case of OIDER services, where the recipient is NOTR. In all other cases, the liability to pay IGST is on the recipient because the transaction is under reverse charge. Next, in case of service supplied by a person located outside India by way of transportation of goods by vessel from a place outside India up to custom stations of clearance in India, IGST is to be paid by the importer. In other words, in case of foreign shipping lines providing inbound transportation of goods from place outside India up to custom stations, IGST is to be paid by importer. However, in a very famous decision, that is of Mohit Minerals, Honorable Supreme Court has held that since importer is liable to pay IGST on composite supply, that is when you value the goods, you even include the freight. Hence, it comprises of supply of goods and also the transport service, insurance, etc. A separate levy on Indian importer for supply of service by the shipping line would be in violation of Section 8 and would amount to double taxation. Hence, there cannot be a separate levy of IGST on the component of ocean freight by the foreign exporter to the foreign shipping line in CIF contracts. In case of importation of order service by a non-taxable online recipient, supplier is liable to pay IGST. And in case of importation of notified services through ECO, ECO is liable to pay. Now, what are the exemptions relating to import of service? There are a few exemptions that you study in the exemption chapter. Now, coming to this important discussion point, that is importation of order services. So what does section 14 provides? That whenever order services are, now there are two possibilities. It is imported by business entity or it is imported by non-taxable online recipient. So where it is imported by the business entity. Now in this particular case, we have to check the place of supply provisions, and depending upon the place of supply provisions, you will determine whether it is import or not. So for supply to be taxable under GST, the place of supply should be in India. In case both the supplier of order service and recipient of service are in India, the place of supply would be the location of recipient and the tax is under forward charge. However, order service can also be provided online from a remote location outside India. In such cases also, where supplier of order is located outside, recipient is located in inside, and the place of supply is in India, the transaction will be liable to tax under RCM if the recipient is business entity excluding government, etc. Thus, in such cases, the recipient located in India would be liable to pay IGST under RCM and undertake necessary compliances. So if the recipient is business entity, RCM triggers. However, if the recipient is a non-taxable online recipient, like common citizens like you and me, in such cases, the supplier is liable to get registered and the supplier is liable to pay. That is what we discussed. Next, provision or facilitation of order services, where this is provided by intermediary located outside India. Now, the order service supplier, who is the supplier outside India, is required to make all the compliances where the supplier is supplying to a NOTR, that is non-taxable online recipient. In such cases, all compliances has to be done by the supplier, either by himself or by appointing a person. Now here an indicative list is given as to what will be order services, and all these services where, if you remember the definition, where the delivery is mediated through some information technology first, and second, it is impossible to provide those services without using technology, all those will be order services. Now coming to next point, certain services when supplied through ECO, and these are notified services, the tax is payable by the ECO. If the ECO does not have physical presence in India, then they will have to appoint a person in India. Now we all know what are these services. The best example is Ola Uber. So where this Uber is, I'm sure Uber now or Ola is a US based app. So for the purpose of complying with 5.5, they will have to take registration in India or they will have to appoint a person in India. Otherwise, they will not be able to provide these online services, because in this case, the ECO, that is the app itself, is the person who is liable to pay tax. Fine. We'll take a pause here. We'll take a break. So we'll take our 15 minutes break here. And then after the break, we'll proceed with the other aspects. So join after 15 minutes. So we continue this topic. Let us continue, students. Yeah. Now the next part is registration and ITC in case of import of goods and services. Now we have to understand that registration is compulsorily applicable as per provisions of section 24 whenever you are liable to pay tax under RCM. Now, in case of import of goods where the ITC is to be availed, you will need registration, but not for import, but for availing ITC. Since import of goods is not covered under RCM, you can import even without taking registration on the basis of PAN and the IC code, import export code. But practically, if you want to avail the benefit of ITC, you will have to take registration. This is what is the main point. This is what is applicable in case of import of goods. So reverse charge provision do not cover importer of goods. Importer are also not listed among categories of person in section 24 for whom GST registration is compulsory. It may be noted here that it is mandatory for the importers who are registered under GST to code GSTN in the bill of entry, but this is only if they want to avail ITCs. So that is what we discuss. Then second part is in terms of section 23, where a person is exclusively engaged in supply of goods, import, export, that is either not liable to tax or wholly exempt, are not required to obtain registration. In such cases, PAN, which is authorized as IEC by DGFT, would suffice. Now, when it comes to import of service, in import of service, the scenario changes. That import of service, which is under RCM, here you become liable for registration compulsorily because of operation of 24, because 24 provides that where you are covered under RCM and you are the person liable to pay tax, you will be required for compulsory registration. That is irrespective of whether or not you want to avail ITC. Now, with respect to ITC for IGST paid on import of goods, it is covered in the definition of input tax. So whether it is paid by yourself or it is paid under RCM, in either case, whatever GST is paid, it will always be covered in input tax definition. And once all the requirements of section 16 are met, it will become your eligible ITC. Same thing applies for importation of services. Now we switch on to the export side. So one of the fundamental principles to make export competitive in international market is to make it tax-free. Hence, export to destinations outside India as well as supplies to SEZ have to be treated as zero rated. Now, SEZ is a zone which is physically, geographically in India, but for tax purposes, it is treated as a foreign territory. That is, whatever supplies are made to SEZ have been treated as zero rated to give them the tax benefits, because generally SEZs make exports. So the export chain should be tax free. Hence, when you supply to SEZ, that is also treated at par with exports. The only condition put is it should be for their authorized operations. Thus, it can be seen that supply to SEZ or developer is treated as part with physical exports. Now we go to the statutory provisions. But before that, there is one important provision, which is the 0.1 tax rate. Now here there is a wrong notion. What is a wrong notion? I'll explain that, because we'll discuss that point also when we come to that point later, which is deemed exports. Now, under the old tax laws, before GST, that is under VAT, if let us say I am the final exporter who is selling goods or sending goods outside India, and I'm buying those goods from you. So between you and me, it is a domestic transaction. So you are also in India, I'm also in India. When you supply goods to me, it is a domestic transaction. And when I supply it further, it is actual export. Now, under the VAT laws, when you supply to me and I further export it, what I am doing is actual export, and what you are supplying to me was deemed export. And under the earlier VAT laws, complying with the relevant forms, if I'm not mistaken, it was Form H, if I'm right. If those compliances were made, then the supplies by you to me, which is a domestic transaction, was deemed to be export and also was exempted similar to export. However, the same transaction under GST is no more considered as deemed export, though people are wrongly considering it as deemed export, but they are not deemed exports. Which transaction? So same, I have got some export order, and for complying with that export order, I am purchasing from you. So between you and me, there is a domestic transaction which may be interstate, intrastate, depending upon the nature of transaction. Important point, this transaction is not deemed export. Hence, the GST law applies in normal course. If it is within the same state, it will be intrastate. C plus S will apply. If it is interstate, it will be interstate. So IGST will apply. Now, in this particular case, because of the working capital blockage for the exporter, because he was purchasing, let us say I'm purchasing from you with full GST, and till the time I export and get the refund, my ITC is getting added as my working capital. So to give them a relief, a provision came that you can supply as an option, not a compulsion, either at the normal rate, whatever is applicable, 5, 18, 28, 40, whatever it is, or you can supply it at a discounted rate, which is 0.1% total. So if it is CNS separate, it is 0.05, 0.05. It is, if it is only IGST, it is 0.1. Now, when this type of supplies are made, you are selling to me. You are the manufacturer exporter. I am the merchant exporter. And in this particular case, you can, following the specific option given, sell it to me at 0.1% instead of the normal rate. But with this comes certain other compliances that when I'm filing shipping bill, I have to mention your name as manufacturer exporter. I have to give you the copy of the shipping bill and also to your jurisdiction officer, etc. But this option is given. But again, I will repeat, this transaction between you and me is not deemed exports under GST as it was earlier. Then the question is, then what is deemed export? So as we studied above, section 147 will notify what is deemed export, and following are the transactions notified. So supply of goods only, not services, from DTA, that is from a normal zone, to EOU, EHTP, STP, BTP, these will be considered as deemed exports and are allowed some of the benefits that actual export enjoy, but not all the benefits. So you have to be clear that firstly, merchant export transactions are no more deemed exports, and the deemed export transactions are only those which are notified under section 147. Now, interstate supply covers where supplier is located in India and place of supply outside, where supply is made to SEZ. So here you don't see the place of supply. For SEZ transactions, the place of supply is always the GST implication is always IGST. So even though the SEZ is in the same state, the tax levied will be IGST. You have to keep this in mind. And next thing which will be IGST is where the supply of goods or service is within taxable territory but not covered in intrastate definition. Next, what will be establishment of distinct person? So this provision is important. So for the purposes of this act, where a person has an establishment in India and also any other establishment outside India, then such establishments, that is in India and outside India, shall be treated as establishment of distinct persons. Or an establishment in a state, union territory, and any other establishment outside state, union territory, again they are establishments of distinct person. Third, establishment in a state, union territory, and any other establishment registered within that state or union territory. So my two units, whether in same state, whether in different states or in different countries, shall be treated as establishments of distinct persons. Second explanation, a person carrying on business through a branch or an agency or a representational office in any territory shall be treated as having an establishment in that territory. So if I'm having a branch or any other representational office or even where I am doing business through an agent, all these places will be treated as my establishment. Next, place of supply of goods imported into or exported outside India. The place of supply will be determined by section 11. So for exports, the place of supply is always the place outside India. Similarly, for services, section 13 determines the place of supply, and that will help you decide whether or not your services are export. Now, very important is the definition of zero rated. Your transaction, which is fitting in zero rate, will become eligible for refund under section 54. So that is why this definition is very important. What it says, zero rated supply means any of the following supplies of goods or service or both, namely export of goods or export of service, or supply of goods or service for authorized operations to SEZ or SEZ developer. So strictly two transactions only will be regarded as zero rated supply. One, export goods service or supply of goods service for authorized operations to SEZ. Now, subject to provisions of 17(5), that is blockage of ITC, credit of input tax may be availed for making zero rated supplies, notwithstanding that such supply may be exempt. Now, this is an important point. Generally, where your outward supply is exempt, firstly, you're not allowed ITC. Secondly, for common ITC, you have to do proportionate reversal. However, where your outward supply is exempt, but it is zero rated, means what? Let us say there is some exempt goods, zero rated goods. Zero rated means nil rated, sorry, where the rate given in the rate schedule is zero, that is nil rated, which falls in exempt supply. When these goods are sold outside India, that is exported outside, or these goods are sold to SEZ for their authorized operations, we will call that exempt supply also as zero rated. And once that supply is a zero rated supply, it will no more be referred to as exempt. In other words, you will be eligible to take ITC. In fact, you will be also eligible to take refund of that ITC if other conditions are met. A registered person making zero rated supply shall be eligible to claim refund of unutilized ITC on supply of goods, service, or both if he is making the export without payment of tax under bond or annuity in accordance with the provisions of section 54 and the corresponding rules. Provided that registered person making zero rated supply of goods shall, in case of non-realization of sale proceeds, be liable to deposit the refund so received under this subsection along with applicable interest within 30 days after expiry of the time limit. So this provision requires that when you are exporting goods, you should ensure that the money, the sale proceeds should come to India, should be repatriated to India within the time limit prescribed under FEMA. Further, the government may, on the recommendation of council, subject to such conditions, safeguard or procedures, specify what class of person who may make zero rated supply on payment of IGST and claim refund, class of goods or service which may be exported on payment of IGST. So this is what this is bringing a restriction as to where the refund can be allowed on with payment option, that is where exports can be made on with payment option. So it says that the government may, on recommendation and subject to conditions, safeguards, procedures, what they will specify. First, person, that is class of person means the taxpayer who can make zero rated supply with payment of IGST, and even class of goods which can be exported under the with payment option. And then section 145 or 147 authorizes the government to notify which supplies will be called as deemed exports. Now let us go to detailings. Now, what will happen if your supplies are zero rating? So if your supplies are zero rating, firstly, for outward, you have an option to pay tax, not to pay tax. That will be your choice. So you may export without paying tax. That is a benefit of zero rating, that is without levying any GST. And at the same time, on the input side, whatever is the ITC, you are eligible to take refund by complying with the refund procedure. Further, Circular 1 has clarified that the provisions of 16 relating to zero rated supply will also apply to compensation cess. Hence, exporter can claim refund of compensation cess paid on goods exported by them in case of notified class of person making zero rated supply of export goods or notified class on goods or service. So wherever your goods or services are liable to compensation cess, over there also zero rating provisions are applicable. So you can even claim refund over there. Now, many times people mix between zero rated supplies and exempt supplies. Now, firstly, exempt supply includes three types of supplies. One, where the rate is zero, that is not zero rated, where the rate is zero, so you call it as nil rated, where it is fully exempt by notification, or where it is not leviable to GST. Now, all these three combined are called as exempt supplies. What is a zero rated supply? A zero rated supply can be any of these, or it can be a taxable supply. So any of the supplies, taxable and exempt both, which are either exported or which are given to SEZ for authorized operations, those will be zero rating. No tax on outward because they are exempt. However, the input supplies used for making exempt supplies to be taxed. So there will be tax on the inward side. On outward supplies, there is no tax. Here also the onward supplies is not tax. Inward supplies, even if there is a tax, that will be refunded. So it will also as good as become tax free. Credit of input tax need to be reversed if taken because ITC is not available for exempt supplies. And credit of input tax may be availed for making zero rated supplies even if supply is exempt. ITC allowed on zero rated supplies. Next, the value of supplies for the purpose of apportionment shall include some deemed supplies. So these are those deemed supplies which will be covered for the purpose of doing the proportionate reversal. Value of zero rated supplies shall be added along with taxable supplies. So these are some differentiating points. Now, taxability of exports. So exports are treated as always interstate supplies. Hence, the tax wherever applicable will be IGST. Now, what is exports we discussed in the definition? Export is defined to mean to take outside India. India is defined as extending to the limits of maritime zones, which is 200 nautical miles. This is far beyond the normal definition, which only includes territorial water, which in turn means 12 nautical miles. Given the extended meaning of India, export would require that the goods must travel beyond the 200 miles, 200 nautical miles from the baseline. Only then it will qualify as exports. Now, some important pointers. Sending goods out of India for exhibition or on consignment basis for export promotion. So many times we have to send goods outside so that they can be displayed in some foreign exhibition or they can be distributed there for the purpose of my export promotion. Now, in this case, the question is what will be the GST implication? Because practically these goods are going out, but they are not getting sold and they may not be written back. Now, in such cases, Circular 108 has clarified that activity of sending goods out of India for exhibition or on consignment basis for export promotion, except when such activity satisfies the test laid out in Schedule 1, does not constitute a supply as the said activity does not fall within the scope of Section 7. So where you are simply sending them outside for exhibition, it will not be any type of supply. Since such activity is not supply, the same cannot be considered as zero rated as per the provisions of 16. Thus, activity of sending, taking specified goods outside is not a zero rated supply. That being the case, execution of bond LUT as required under 16 is not required. Now, what are deemed exports? They are the one which are notified under Section 147. Most important, whenever you are engaged in any of these deemed exports, which are only these notified supplies, not any other supplies. First point, for these notified supplies, there is no exemption. Let me make it clear. So deemed export does not mean you can make these supplies without payment of GST. In fact, regular GST will apply on these supplies. Second, though they are called as deemed export, it is not that only IGST will apply. So again, on these supplies, the normal tax, whatever it is C plus S or I will apply. So two things about deemed supply. One, they are not exempt like export. They are not zero rated. Two, whatever tax is applicable, C plus S or I, anything may apply depending upon the actual nature of supply. 3. For these supplies, there is no benefit of 0.1% as it is applicable for merchant export transactions. So these supplies, wherever they happen, will be taxed at the normal rate of GST. 4. Very important. Then you will say, sir, then what is the benefit of notifying them as deemed export? The benefit is these supplies, after payment of tax, can or is eligible for refund. Means what? See, now what happens in case of export, you are given the option of not paying tax in the first place. But since these are not export, these are deemed exports. So let us say I am making a supply to you, and this supply is of goods under advance authorization or against the advance authorization license. So where I'm making the supply against my advance authorization license, such supplies would be covered under deemed export. Now in this particular case, there is no exemption. So firstly, I will charge the full GST. This will be reported in my GSTR1, this will be reported in my 3B, and I will be discharging the full GST. Now, the benefit of deemed export is either me, that is a supplier, or either you, that is an advance authorization holder, or the buyer. Any of us can claim the refund. This is where this supply becomes special or different from regular supplies, or this is what is the benefit of deemed export supplies. So, first, tax will be paid in the normal manner without any relief or concession. But after payment of tax, either the supplier or the recipient, as per the option agreed between them, one of them will be taking the refund of this particular transaction. This is what is the special point about deemed export. So, what are the supplies covered under deemed export? Where supplies are made using the advance authorization license or EPCG license. So, let us say you are having one of these licenses and you are buying domestically any goods or capital goods from me. So, you can ask me to supply it to you under the advance authorization. And once I supply it to you under the advance authorization, the supply becomes a deemed export. Next, if you are EOU, the supply of goods which I'm making to you will also fall under deemed export. And lastly, supply of gold by a bank or PSU as notified in notification 50 bar 2017 against advance authorization. Now, what is the taxability? As I said, all supplies which are notified as deemed export are applicable to levy of taxes in the normal manner. Further, such taxes are to be paid in full. There is no benefit of using the bond or LUT and making a supply tax. This benefit is not there. Further, then what is the benefit? After payment of tax, the refund of tax for such deemed export is allowed, and it can be taken either by the supplier or by the recipient. Mutually, they will have to decide, and accordingly, the compliances have to be made. Merchant export we discussed above, that if I am the final exporter and I am purchasing from you, then this transaction becomes merchant export. In this case, you will be the original manufacturer and I am only the trader. So I'm called as merchant exporter. And you can supply the goods to me at a discounted GST rate of 0.1%. In such cases, some procedures have to be followed. Importantly, circular number 125, which is the master circular for refund, has clarified that the exporter who is receiving the goods at this concession rate of 0.1 will be eligible to take rate of this concession rate. So I can take the rate of 0.1%, which will eventually get refunded to me. Further, you, the supplier who has supplied at this concession rate, will be eligible for refund of ITC. So you have claimed some ITC, which is at normal rate. You have made the supply to me at discounted rate of 0.1. So your case gets covered in another refund option, which is the inverted duty structure. So because of which you will also be eligible to claim refund of the difference in tax, which tax? Input tax and output tax. Now, there are some procedural requirements. So first, whenever I am purchasing from you under 0.1% rate, that is a concession rate, then I do not have the option to make export on with payment option, I will have to compulsorily make export under non-payment option, that is LUT or bond option. Further, Circular 8/8 has clarified that there is no provision for issuance of CT1 form. So these were all old forms. Now there is no such requirement. Manufacturer exporter means a person who export goods manufactured by him or intends to export such goods. Merchant exporter means a person engaged in trading activity and who exports or intend to export goods which are manufactured by someone else. A registered supplier can supply goods to merchant exporter at this lower price of 0.1% prescribed under notification 41 and 40. Now, what are the conditions? So this is the procedural part. If you want to take the benefit of 0.1%, the registered supplier, that is you, shall supply the goods to me using a proper tax invoice. Then me, that is the recipient, shall export the goods within the period of 90 days from your date of invoice. Then me shall indicate the GST number of you on the the tax invoice number issued by you on the shipping bill or the bill of export as the case may be. Then me shall be registered with the respective export promotion council to which my product or my business belongs. Then me shall place an order on you for procuring goods at concession rate, and copy of the same shall also be provided to your jurisdictional tax officer. So your tax officer should be informed prior that I want you to supply me goods at concession rate. Now me shall move the goods from place of yours directly to the port or to the inland container depot, etc., etc., or directly to the registered warehouse from where the said goods shall be moved to the port, etc. So the basic point is I should not be bringing it to my main place of business because there cannot be any manufacturing done by me. So either from your place, I should directly send it to the port, etc., from where they will be exported, or directly to my registered warehouse from where the said goods shall be moved to port, etc., and from the port they can be sold. So registered principal place of business or registered additional place of business are deemed to be a registered warehouse. Now, if me intends to aggregate supplies from multiple suppliers and then export, the goods from each registered supplier shall move to my registered warehouse, and after aggregation, me shall move the goods to port, inland container depot, airport, etc., from where they can be exported. In case of situation referred to above, that is when I am aggregating, me shall endorse the receipt of goods on the tax invoice and also obtain acknowledgement of receipt of goods in the registered warehouse from the warehouse operator, and the endorsed tax invoice and the acknowledgement of warehouse operator shall be provided to you as well as your jurisdiction officer. Now, after these goods have been exported, me shall provide the copy of shipping bill of export containing my GSTN and also your GSTN, including the details of tax invoice, along with the proof of export general manifest, that is the goods are exported to you as well as your officer. Merchant exporters may exclude commercially sensitive information while providing copies of shipping bills to registered suppliers. So sensitive information could be my further export price can be erased so that you do not come to know my profit margin. Now, service exports will be treated as exports if following conditions satisfied: supplier is inside India, recipient is outside, consideration is in foreign currency, place of supply is outside, and the transaction should not be between two branches of the same person. Branch and head office of one taxable person are not treated as two separate entities, so transaction between them will not be eligible for export. In other words, provision of outbound service inter say branch and head office is not to be constituted as export of service. However, notification 9 exempts the service provided by an Indian establishment to its foreign establishment from IGST if place of supply is outside India. So though it will not be considered as export, still exemption can be claimed. Apparently, now interestingly, branch and head office, it is not export. But what about transfer between holding and subsidiary? Now, holding and subsidiary are two different companies having two separate company registrations. So we do not fall under the same entity, though through ownership or holding of shares, the holding company may be controlling the subsidiary company, but we are not part of same entity. We are not having same PAN. Now, in such cases, transfer between a subsidiary and holding will qualify as exports. Why? Because we are two separate legal persons. So above restriction, that where transactions between entities of the same person or branch of the same person will not be export of service, that restriction does not apply over here in case of holding subsidiary, because we are two separate persons having two separate PAN. So this point has to be noted. So head office branch, it will be a different scenario, and holding subsidiary, it will be another different scenario. Thus, provision of outbound service inter-se subsidiary holding can become export of service if all other conditions relating to export are fulfilled. Under service tax law, there was a judgment by the Honorable Gujarat High Court in case of Linde Engineering, etc. And service tax law is identical in this aspect. Now, as in case of export of goods, even in case of export of service, India means up to the 200 nautical miles as per the Maritime Zone Act. Now, some important issues clarified by circulars. So, subcontracting of service by an exporter of service to another person located outside India. Now, what is this? If exporter of service outsources some part of the service contract to another person outside India, there may be instances where the full consideration for the outsourced service is not received by the exporter in India. So why? So let us say I receive a contract from US where for execution of this contract, I have taken services from some local person in US, because otherwise I'll have to send a person from India, which may incur cost. So let us say I have received a contract for $10,000, and the local person whom I have hired in US who will be doing some local work, I have to pay $4,000 to that person. Now, many times in such scenario, it so happens that while making payment, I receive the net, because see, I was supposed to receive 10,000 and I was supposed to pay 4,000. But locally, 4,000 is paid there and I receive 6,000. Now, in this particular case, the challenge is my export bill is of 10,000, but I'm receiving 6,000. In this case, how will I get the refund? Because one of the requirements for refund is that I should receive the payment. Now, here I have received the payment, but not the full amount. So, what is clarified in this? Where the exporter of service outsources a portion of service contract to another person, there may be instances where full consideration is not received by the exporter. The tax treatment of said portion of the contract at the hands of exporter is discussed and explained below. So where exporter of service is located in India, supplying certain services to recipient outside, either wholly, partly through any other supplier outside, the following two supplies are taking place. So logically, first, there is a supply of service from exporter of service in India to recipient outside India. Second, there is import of service by this exporter. From whom? From that local connect. Now, the total value of service as agreed to in contract between the exporter and the recipient outside will be considered as export, correct? The supplier of service located in India would be liable to pay IGST on reverse charge on the import of service portion, correct? So whatever 4,000 the other person is going to charge me, that becomes import of service, for which I have to pay IGST and a reverse charge. Further, the said supplier of service would be eligible for taking the ITC of this IGST paid under RC. Thus, even if full consideration for the service as per the contract value is not received in convertible foreign exchange. Now, this is the main crucial part, because for me, the challenge is getting refund of my export. Why? Because one of the conditions for export of service definition is that payment should be received. Here I am receiving payment, but not for the full portion. So, due to the fact that the recipient located outside India has directly paid to the supplier located outside India for the outsourced part, that portion of consideration shall also be treated as receipt of consideration. It means even though this amount is not physically received, it will be deemed to have been received, provided IGST has been paid by the supplier in India for the import of service under RCM. So even though I have not received that 4,000, but I should pay IGST because to that extent it is my import of service. RBI has general or specific approval, has allowed that part of consideration to be retained outside. So there should be an RBI approval for the same. Now, supply from a company incorporated in India to its related establishments outside India, which are incorporated under the laws outside India, qualifies as export of service. Now, what is this? Generally, services are provided by subsidiary, sister concerns, group concern, etc. of a foreign company in India, which is incorporated under the laws in India, to the foreign company incorporated outside India. So, there is a foreign parent, it has created some subsidiary in India, or there are two companies which are sister companies. Why? Because they are under the same management. Now, where there are two such companies, one in India, one outside, and the Indian company exports some services to outside. The question is, can we two companies be considered as establishment of some same person? Now, when we are considered as establishment of same person, the problem is such transaction, because of the definition of export of service and explanation under one, will not become eligible for export. So the question is whether this transaction between a holding subsidiary or between two sister concerns will not be regarded as export. For this, it can be stated that supply of services by a RBA of a foreign company not incorporated in India to any establishment of the said foreign company shall be treated as supply between establishment of distinct person and shall not be considered as export of service. Correct? But this is when this branch of the foreign company is not incorporated in India. But what will be the answer if it is incorporated in India? In such case, similarly, and supply of service by a company incorporated in India to its RBA located outside India and not incorporated under the laws of said country shall also be considered a supply between establishments. So again, where the outside person is unincorporated, still it will not be an export of service. Why? Because it will be considered as supply to my own counterpart. So what is important is, in order to get out of this particular issue, both these companies should be incorporated in the respective countries. If any one of the company is incorporated and the other is not incorporated, then they will be deemed to be branches, or they will be deemed to be establishments of the same person, and hence export will not be eligible export of service. So for the purpose of final answer, the answer is supply of services by subsidiary, sister or group concern of a foreign company which is incorporated in India as per the company's laws and thus is a separate company in India to the establishment of the said foreign company located outside and incorporated outside would not be barred by the last condition of the definition of export, as both are not merely establishments of the same person, but they are actually two distinct persons. Similarly, supply from a company incorporated in India to its related establishment outside India, which are incorporated under the laws outside India, will again not be treated as supply merely to your branch. In other words, where the foreign counterpart and the Indian counterpart both are registered under the respective countries companies law or companies act, then it will be regarded as export of service and the restriction will not apply. Now, some provisions relating to SEZ. Now, whenever you are making supply to SEZ unit or to SEZ developer, it is regarded as zero rated. But this is coming with a condition which was earlier not specifically mentioned. So there were some disputes. It has been specifically added that such supplies will be regarded as zero rated only if such supplies are received by the SEZ for their authorized operations. Now, this is what is provided in the letter of authority given to a SEZ what would be their authorized operations, plus the SEZ law has given a list of what could be the different uh, transactions, that is goods or service, that could be considered as for authorized operations. Now, whenever you are supplying any goods to SEZ, you have to check with the SEZ whether those goods or services are meant for their authorized operations and take a type of declaration from the SEZ in this regard. When you raise invoice on the SEZ for those good services, those invoices are to be checked and are to be, you can say, authorized by the SEZ commissioner. Only when the SEZ commissioner authorizes and endorses on those invoices, stating that yes, these invoices or these goods and services are actually meant for the authorized operation of the SEZ, then only the criteria of zero rated supply is met, and you will be getting the benefit of zero rating, that is either uh, sending without payment of any tax or making payment of tax and getting the refund. This is very important. Now, services of short-term accommodation, conference, banquet provided to SEZ developer, whether to be treated as interstate supply or intrastate supply. Now, this is a clarification because there was a conflict. What is the conflict? So let us say I am a hotel and a SEZ unit wants to organize some of their business functions or some meetings in my hotel, whereby I'm providing them either accommodation or conferencing or banquet facilities. Now, we have a provision for hotels which says that for hotels, the place of supply is the location of hotel. Now, when a SEZ, which is physically an entity in India but given a special status, and the hotel, when both are in India, and let us assume both are in the same state, can such a transaction be treated as a supply to SEZ and becoming eligible for being treated as interstate supply? Because in such a case, wherever a hotel supplies accommodation or conference facilities, it will always charge C plus S. This is what is the mandate of law. However, this mandate has an exception that whenever the hotel is raising invoice on a SEZ unit or a developer, irrespective of what is provided in Section 12 place of supply, as per this circular, it is clarified that the services of short-term accommodation, conferencing, banqueting, etc., provided to SEZ unit or developer shall be regarded as interstate supply. So even though in normal case, hotel will always charge C plus S, but when the hotel is providing their accommodation or conferencing or banqueting services to SEZ, it will always raise IGST invoice only. Then transactions with EOUs. Now, interestingly, we have discussed this above also. EOUs are not enjoying any special status like SEZ. So transaction with EOUs are normal. All GST law applies to EOU transactions in the normal manner. Supplies to EOU are taxable like any other supplies. EOU to the extent of exports are eligible for zero rating. Again, this is like any other exporter. But what is then the special benefit for EOU? Supplies to EOU are qualified as deemed export vide section 147 read with the respective notification. And in that case, when I supply to EOU, firstly, I will pay the full tax. And after that, after filing my 1 and 3B and paying the full tax, either me or the recipient EOU, any of them can avail the refund. This is what is the benefit. Now, procedure for export under bond LUT without payment of tax. Procedure for merchant export, we have already discussed this above. Procedure for direct export. Rule 96A of the CGST rules. Now, when I'm exporting goods or services, Rule 96A provides that I should execute a bond or LUT prior to the export. And what is this bond or LUT saying? It is for binding myself to pay the outstanding tax along with interest within what time period? In case of export of goods, 15 days after the expiry of 3 months or such other period as may be allowed from the date of issue of invoice if goods are not exported outside India. So indirectly, they are providing me 3 months to complete my export. If not, after that, within 15 days, I'll have to pay the tax along with interest. Similarly, for export of service, 15 days after expiry of 1 year or the period allowed by FEMA, including any extension of such period as permitted by RBI, whichever is later, from the date of issue of invoice for export or such further period as may be allowed, if the payments of for such service is not received by the exporter in convertible foreign exchange. Now, see, for export of service, there is no proof of physical export like how you have in case of export of goods, you have shipping bill, you have EGM. There are so many proofs. But for export of service, there is no custom clearance, so there is no proof. Hence, for this, you have to provide another proof that is receipt of payment. So if you are receiving the payment against such services, then it will be qualifying for the benefit. Otherwise, you'll have to pay the tax along with interest. Now, these provisions are also applicable in respect of zero-rated supply of goods service to SEZ without payment, that is under LUT. Now, proviso to section 16(3) provides that a registered person making zero-rated supply of goods without payment of tax shall, in case of non-realization of sale proceeds, be liable to deposit the refund so received under 16(3) along with applicable interest under section 50 within 30 days after expiry of the time limit prescribed under FEMA. So, even in case of export of goods, though Rule 696A has not provided this condition, but proviso to 16(3) says that even for export of goods, the payment, that is the sale proceeds, shall be received within the provided time limit. And if that is not done, in such cases, non-realization of sale proceeds, if sale proceeds are not realized within the time frame of FEMA Act, then I would be required to pay the tax along with applicable interest. Yes, Swaminathan, it is 9 months. You're right. So the normal time limit for under FEMA is 9 months. Now, Rule 96B prescribing the manner in relation to this lays down that the proceed of export of goods need to be realized within the period allowed under FEMA for receipt of foreign exchange remittances. Non or part realization of such proceeds may result in recovery of refund. So whatever refund you have received, you will have to return it back. Failure to export goods and pay the tax due along with interest within the period specified in A above results in withdrawal of facility of export without payment of IGST and recovery of the said amount under section 79. So simply, if you have not exported the goods, so originally you prepared invoice of export, the goods maybe were moved from your factory or your premises to the port, but for some reason they are not eventually exported at all. So by default, there will be liability and your facility of export without payment will be withdrawn. However, once you make the payment, the facility would be restored. All registered persons are eligible to furnish LUT in place of bond, except those who have been prosecuted for cases involving an amount exceeding 2.5 CR, that is 250 lakhs. So instead of getting a bond, you can simply furnish LUT, which is much easier on the portal. But in case you have been prosecuted for any amount exceeding 2.5 CR, you will have to furnish a bond. Next, the details of export invoices should be uploaded in GSTR1. These details shall be electronically transmitted to the system designated by the customs, that is the ICAI portal, and a confirmation that the goods covered by the said invoices have been exported out of India shall be electronically transmitted from the ICAI portal to the GST common portal. So whenever you file your GSTR1 and upload your export invoices under the export invoice table of GSTR1, when you upload it in GSTR1, you give different details like port code, etc., EGM. Hence, this GST portal gets all the details of your export of goods. So it connects with the IceGate portal because on IceGate portal, similar details are uploaded. So both the portals intersect, cross checks the details, and once the details are matched, technically your export is confirmed. Now, some clarification relating to issuance of bond or LUT, Circular 8 bar 8, as amended by Circular 40 bar 14 and further by Circular 88 bar 07, has clarified the following with respect to furnishing of bond. First, validity. The LUT shall be valid for the whole financial year. However, in case the goods are not exported within the time frame specified in Sub Rule 96A and the registered person fails to pay the amount mentioned in the said sub rule, the facility of export under LUT will be deemed to be withdrawn. If the amount mentioned in the said sub rule is paid subsequently, the facility of export under LUT is restored. So as we saw above, 3 months is the time provided by Rule 96A to actually export your goods. If that is not done, you have to pay the tax relating to those goods along with interest. Now, what is the form for issuing the bond or LUT? The registered person shall fill the relevant form on the portal. So the portal itself is providing you a form, and LUT shall be deemed to be accepted as soon as acknowledgement for the same bearing the ARN is generated online. So today, generating LUT is very simple. You simply go to the portal and you fill in the details and upload. That itself will be generation of LUT. No documents are needed to be physically submitted to the jurisdiction officer when you are generating LUT. LUT shall be deemed to have been accepted as soon as an acknowledgement for the same bearing the ARN is generated online. If it is discovered that the exporter whose LUT has been so accepted was ineligible to furnish LUT, then the exporter's LUT will be liable for rejection. Bank guarantee. Since the facility of export under LUT has been extended to all registered persons, bond will be required only where a person was executed for a value above 2.5 lakhs. A bond in all cases shall be accompanied by a bank guarantee of 15% of the bond value. Then clarification regarding running bond. Now, what is running bond? So at times when you are a regular exporter or regular importer, you may take a lump sum bond of, let us say, 100 crore. So 100 crore is credited. Now, out of that, you utilize 20 crores, 40 crores for some other removal which requires bond. Then to that extent, the amount is debited. Once you comply with all the procedures and your duty payments are done, again the amount is created. So that is what is the concept of running bond. Sealing by officers. Till mandatory self-sealing is operationalized, sealing of containers wherever required to be carried out under supervision of officers shall be done under the supervision of excise officers having jurisdiction over your place of business. Next, realization of export proceeds in Indian rupees. Now, we saw that your sale proceeds should be realized in convertible foreign exchange to be eligible for export. However, there are some concessions where export proceeds can be realized in rupees also. What are they? Part A 5, Part 1 of RBI Master Circular dated 1st July 15, updated on 5th November 15, states that there is no restriction on invoicing of export consignment in Indian rupees in terms of rules, regulations, notifications, and directions framed under FEMA. Further, Para 2.52 of Foreign Trade Policy, all export contracts and invoices shall be dominated either in freely convertible currency or Indian rupees, but export proceeds should be realized in convertible foreign exchange. However, export proceeds against specified exports may be realized in rupees provided it is through a freely convertible pass-through account. So this is where even realization in foreign currency has been relaxed. Accordingly, it is clarified that acceptance of LUT for supplies of goods services to countries outside India or SEZ developer SEZ units will be permissible irrespective of whether the payments are in Indian currency or convertible foreign currency as long as they are in accordance with applicable RBI guidelines. Jurisdiction officer in exercise of power conferred under subsection 3 of 5 of CGST, it is hereby stated that LUT bond shall be accepted by the jurisdictional deputy commissioner or assistant commissioner having jurisdiction over your principal place. Now, some special treatment for exports to Nepal and Bhutan. See, these are landlocked countries. So, RBI regulations allow receipt of payment in Indian rupees in case of exports to Nepal and Bhutan. Further, in case of exports of goods under GST law, receipt of export proceeds in convertible foreign exchange is not a prerequisite. Hence, export of goods to Nepal, Bhutan will be treated as zero rated. Consequently, will also qualify for all benefits available to zero rated supplies, that is refund. Further, for export of services, in case of export of services, where permitted by RBI, receipt of payment in Indian rupees is allowed. As stated earlier, RBI regulations allow receipt of payment in rupees in case of exports to Nepal and Bhutan. Consequently, supply of services having place of supply as Nepal or Bhutan can be export of service even if payment is received in Indian rupees. Clarification. Now, this is regarding admissibility of export remittances received in special Vastro account as permitted by RBI. So, what is clarified? For the purpose of consideration of supply of service to qualify as export of service. So, one of the conditions is that the payment should be received in convertible foreign exchange or in Indian rupees where permitted by RBI. Now, in this regard, it is clarified that when Indian exporters undertake export of services, are paid the export proceeds in Indian rupees from the special Vastro account of corresponding banks of the partner trading country opened by the authorized dealer, the same shall be considered to be fulfillment of this condition, subject to the conditions restrictions mentioned in foreign trade policy. In short, even where the amount is received in Indian rupees, but in the special Vastro account, it will be considered as compliance of the provisions of export of service, and eventually your service will be regarded as export even though the payment is not received in convertible foreign currency. So these are the various provisions relating to exports, imports under GST. Now I open the forum for your question answers, if any. So if you have any particular questions, let me know. We can discuss it and take it forward. Students, any questions? Yes, students. Any questions on any of the provisions? Okay, Swaminathan says I have no questions. Anybody else? No? So everything clear in this chapter of import export under GST. So let me run through let us recapitulate. So in this, the important point according to me is the difference between these three transactions. One is high C sales, one is the third country consignments, and one is where the goods are lying in the custom bonded warehouses. The differences, all three are treated regarded neither as supply of goods nor as service, but the difference is for the first two transactions, that is high C sales, and second, the sales happening through uh, third party consignments, that is out and out transactions. In both these cases, the transaction is a Schedule 3 transaction and also not regarded as an exempt supply. It means reversal of ITC under Section 17(2) is not required. However, the third transaction, where the goods are lying in custom bonded warehouse and before its clearance, they are sold to somebody else by way of transfer of document of title to those goods. In such cases, in this transaction, third category, whenever the goods are transferred or sold, it is again a Schedule 3 transaction. But the most important point in this is, even though it is a Schedule 3 transaction, the explanation to Rule 43 has included this or deemed this transaction to be a exempt supply for the purpose of computing the reversal under section 17(2). So this particular differentiation is very important. So in case of high sea sales and in case of third country shipments, it is not exempt supply, no ITC reversal under Rule 42 43 required, but explanation to section 17(3) says that the supplies happening while goods are in custom bonded warehouse will be deemed to be an exempt supply, and reversal under 17(2) will be triggered. So this is one very important point. Second important point, students, I think from this chapter is section 14A, which is applying to the case of supply of online money gaming by a supplier who is outside India to a recipient or to a person in India. In such cases, the supplier has to compulsorily pay IGST. The supplier has to take a simplified registration, and the supplier will either himself or through a person in India be liable to pay the tax. Without that, the supplier will not be allowed to operate in India. Geeta has asked how to connect import export with GST. Geeta, we have discussed this whole chapter on that point. Still, if you have any particular point, then please ask specifically, because I did not get your question how to connect import export with GST, because this whole chapter was relating to that only, ki how import export are connected with GST. Swaminathan is asking on import of goods, is there any GST registration needed by export of goods? But IGST will be paid by importer to customs when pay the custom duty. See, export of goods, firstly, export is an interstate transaction. Now, whenever you are exporting service, Section 24 does not mandate compulsory registration for interstate supply of service, but same Section 24 mandates compulsory registration for interstate supply of goods. So whenever you are exporting goods, since it is interstate supply of goods, you will be compulsorily required to take registration. When we come on the import side, as we discussed above, an importer of goods is not required to take compulsory registration. Why? Because it is not under RCM. But importer of service has to take compulsory registration because import of service is under RCM. No, Geeta. When we talk about imports and exports, remember one thing, both are covered under both the laws, that is GST law also and customs law also. Now, first, when we talk about import, firstly, we have to understand that we are only talking about import export of goods. Today, I started the session with this first clarificatory point that when we talk about customs law, service is never covered. The entire custom law is not covering service. So, whenever you are talking about import export of service, it is only the it is only the IGST law or the GST law which applies. But when you talk about import export of goods, then both the law applies, customs law also and GST law also. Right, Geeta? Swaminathan is asking, sir, I am asking on import of goods. Importer will pay the GST along with customs and other duty to custom office, correct? In this connection, is there any GST registration by exporter for the imported goods? See, Swaminathan, exporter is a person who is sitting outside India. So how is that exporter connected? Anyways, the exporter is not required to pay any GST in India. First, the GST has to be paid or the customs duty has to be paid by the importer only. Second, the exporter sitting outside India has no jurisdiction, or our Indian laws are not applicable to that exporter. So why will that exporter take any registration? So in case of import of goods in India, the exporter who is sitting outside India has no domain. So the exporter is never required to take registration in India. I hope this is clear, Swaminathan. Swaminathan, is your question answered, beta? But again, now see, now you are changing the question. First, you talked about import of goods. Now you are talking order. Now, order is a service. For order, we already studied. See, when you come to service, within that, if it is order service, then there are two categories. One, recipient is a non-taxable online recipient. Then supplier outside has to take registration. Second, in case of online money gaming, irrespective of whether the recipient in India is registered or unregistered, the supplier has to take registration. Third, in respect of certain services provided through ECO, which are notified under 5.5, there also the supplier sitting outside India has to take registration. So these are the only three specific cases where the supplier sitting outside has to take registration. Other than this, the supplier sitting outside is not required to take registration. But when you ask the above question, Swaminathan, it was a generic question with relation to import of goods. Now we are talking about order, we are talking about services through ECO. So over there, in these three specific cases, Swaminathan, the supplier sitting outside India has to take registration, and that is where Section 14 of IGST Act and newly introduced 14A of IGST Act comes into picture, where we just studied that the supplier either himself or through a person or through a representative in India will be doing the business, and where the supplier is not appointing any person or representative, the supplier will not be allowed to do the business. Just a minute. Yes, students, any further questions? I hope all your doubts are now clear. Everyone. Great. Others? Yes, are your doubts clear? Good. So students, we stop over here. We conclude our today's session here, and we meet again in the next class with the next topic for our revision. So till then, take good care of yourself, keep studying, and wherever you have any questions, doubts, please post it to us. We will make our best attempt to help you out and ensure that you be successful in your upcoming exams. We had results yesterday which were outstanding. So I bless you all. I wish you all that whenever you all go for your exams, that should be the best exam of your career, and you should stand out with flying colors in that exam itself. So be focused, and we at BOS are always there by your side, by your back, to support you, to guide you, and help you through this beautiful course, which is going to add great value to you at personal level, professional level, and even at society level. So let us all take this course as one of the game-changing opportunity of our life. I've seen many students who had a very difficult background, who have come from a very humble background, but only because of one student doing the CA course, the entire family and all future generations have got a different lifestyle, have got a different standard of living, and thereafter, their family, all the other members have always spent a great life. So I wish that you all become chartered accountants at the earliest opportunity, and you add great value to the society, to your profession, and make your family proud. Thank you all. Thank you very much. Manish ji, good night. Take care. Good night.